Okay with everyone. So good afternoon from Sydney. My name is Trevor Cuthbert, and on behalf of RIMS Australasia, I'd like to thank you all for joining this summit and hope you've enjoyed the previous sessions over the last 2 days. I would like to remind everyone that if you've missed any of the previous sessions, the recordings are available on the RIMS Australasia website. And before we start properly, I'd like to acknowledge the traditional custodians of the various lands on which we work today, and the Aboriginal and Torres Strait Islander people participating in this session. I pay my respects to elders past, present and emerging. As with all the sessions, I'll just quickly run through some housekeeping. The RIMS Summit has been approved for CPD by ANZIIF and NEBA, and you get 1 point per hour per session, and attendees will be emailed attendance certificates post-event for their records. I'd also like to thank Allianz for making this session possible and being a sponsor to the summit. We will be using Zoom. All cameras and microphones are turned off, but please ensure that they stay off to avoid disruption. We will be using the Q&A function at the bottom of the screen to ask questions. So I do encourage you to type your questions, but also upvote any other attendee questions that you're particularly interested in seeing being answered. Just as a reminder that these sessions will be recorded and distributed later, so just be conscious of any comments or questions that you make. And now on to the session. Global commercial insurance prices rose 14% in the first quarter of 2020, the 10th consecutive quarterly price increase. With the impacts of COVID together with a continued reduction of capacity, the insurance market is likely to see the trend of increased pricing and reduced coverage continue for the foreseeable future. Either by necessity or prudence, more and more companies are now looking at alternative options to transfer and manage their risks. On that, it is my pleasure to introduce Richard Green of Allianz Global Corporate and Specialty to provide an introduction to alternative risk transfer techniques and solutions. Based in Asia for 15 years, Richard currently heads up the new Alternative Risk Transfer Unit in Asia Pac for AGCS and is responsible for the underwriting execution of alternative risk transfer business as well as capital solutions. Previously at Marsh, Richard has over 20 years of experience in the ART and related fields. So I'd like to welcome Richard and hand the presentation over to Richard.
Trevor, thank you for that introduction. And welcome everyone to the session. Thank you for joining us, albeit virtually this year. So, as Trevor has highlighted, you know, we're in a time now, I think, where conventional premium rates are hardening across a number of different classes, and it's at that time, I think, that people start to think about whether there might be any alternatives out there which might work for clients in these times, and whether, you know, capacity can be sourced from alternative providers. So today I just want to sort of have a quick run through of what ART is about from our perspective at Allianz, and look into one or two specific areas which I thought might be of interest to you. So it's a little bit of an ART overview. I'm sorry if it's a bit basic for some of you on the call, but I thought it would be a good place to start for this session, and perhaps we can get into some of the real detail at the questions which I'll look to take at the end. So you know, ART to my mind has been around since, I guess, you know, the early 90s. So it's not necessarily that new, but it has changed quite a lot, you know, in recent years, and it's moving in a slightly different direction from where we started. From our perspective at Allianz, I've just put on the screen there our global hubs. So the teams, you know, the main teams there: New York, London, Zurich, Liechtenstein. Bermuda is an important one for us, because I think many of you will know that Bermuda really is the headquarters for much of the alternative, you know, the alternative capital market. And our most recent addition is me based in Singapore, covering the Asia Pacific region. We are part of AGCS. We work closely with AGCS. Got about 65 people across those various hubs that you can see, and I obviously work closely with colleagues in those different regions. So that's where we are. In terms of what we do, I've divided it there into the key segments, and I think there may be some differences, but I think a number of ART players would look at it across these specific segments. So a lot of what we do is in the weather and climate space, and I'll come and talk a little bit about that later on in the presentation. A big one for me in this part of the world is capital solutions. Our capital solutions division is based in Bermuda. And then we have corporate solutions and reinsurance solutions. And those two boxes are more where we're looking at risk financing type transactions, multi-year, multi-line type deals, either for corporates or for insurance companies. Now, we don't need to go into each of those boxes, because what I'm going to do is just go through them in a little bit more detail, one by one, to get a better understanding of what we offer across those different sections. But that's how we look at ART from those perspectives. So I guess the one that attracts most attention these days is probably capital solutions. And with capital solutions, what we're looking to do is to take very often what are conventional insurance risks, particularly nat cat risks, but rather than transfer them to insurers or reinsurers, we are transferring them to what is often called the alternative capital market. Well, what is the alternative capital market? I mean, the alternative capital market consists of investment banks like Credit Suisse, Goldman Sachs, JP Morgan. It consists of pension funds. In fact, pension funds are a very big component of the alternative capital market. It consists of hedge funds. It even consists of high net worth individuals. But essentially what you're looking at is there are many institutions, financial institutions in the world that want to get involved in insurance risk, but they're not insurance companies. And so the question is, how do you get involved in insurance risk if you're not an insurance company? And an alternative capital provides a mechanism for that to happen. And you might say, well, if you're interested in insurance risk, why don't you just go and buy shares in AIG or Allianz? The problem with that is, if you invest in an insurance company, as you know, you're not participating in their underlying risk portfolios. You're participating in them as a company. So it's not their underlying portfolio. It's that, plus their management, plus their strategy, plus everything else. What we look to do in alternative capital is give investors a way of participating directly in an underlying risk. And as you can see from this chart, which actually comes from Aon Securities, you can see how alternative capital has grown over the years in dark blue as a percentage of the overall insurance capital available. So particularly, in the last few years, 2015, 16, 17, 18, 19, if you look, you can see some quite dramatic rises from about 2012 onwards. And alternative capital, I mean, everyone's got a different estimate, right? But alternative capital is reckoned to add up to about 15 to 20% of all reinsurance capital is considered to be coming from those alternative sources. So it is a growing part of the market. It's going to continue to grow, in my view, and therefore it's a section of the market that cannot and should not be ignored. And you can see the progression there. So I've just said that alternative capital is capital provided from non-traditional insurance or reinsurance companies coming from financial institutions. So the next question becomes, if that's who they are, then how do they participate? How does it actually work? How do these financial institutions, how do pension funds get involved in insurance risk? So what we're showing here is we're breaking down that alternative capital. You see it's the same number, about 93 billion on the left. So we're breaking it down into the different types of participation. So how does alternative capital function? It tends to function across these three main headings. So the one on the left, you'll probably be familiar with, cat bonds. Cat bonds been around a long time, since the 90s, and the catastrophe bond is a mechanism by which alternative capital providers can participate in insurance risk. It's simply a bond that's issued whereby the underlying risk is not credit risk. The underlying risk, it's not a corporate bond, it's not a sovereign bond, it's a risk bond. The underlying risk that the investors are taking are related to insurance. And it could in theory be any type of insurance, but it's most commonly, as the name would suggest, catastrophe risks. So windstorms, typhoon, hurricanes, earthquakes. Typically it's cat bonds, but in more recent times, it's probably got a bit more adventurous than just cat bonds, but still predominantly, I would say, nat cat related. I'll go over to the far right, because as you can see, the light blue is the section that's growing the fastest, and that is not a company. Collateralized Re is the name given to a particular technique, and collateralized Re is where alternative capital investors participate in ordinary insurance and reinsurance contracts. And when I say ordinary, I mean they are participating on indemnity contracts. These are not parametric triggers, they're not bonds, swaps, derivatives, they're just bog standard insurance contracts, indemnity insurance contracts that investors can participate in. Now, the issue with these investors, for the most part, is that they're not rated entities. They're not AA rated, they're not carrying Moody's, Fitch and AM Best ratings. And that creates a credit risk. And the way that credit risk is solved is by having those entities post collateral. So in the absence of having a rating like Allianz has and AIG has and Zurich and all the other big insurers, the way these guys get around the credit risk issue is to collateralize their deals. They effectively post collateral with us in the form of cash and other acceptable liquid instruments, so that we know that we can draw upon those funds in the event of a loss. And whilst parametric triggers are popular, a lot of people wanting to participate in insurance want to participate on indemnity-based contracts, not parametric-based contracts. And for those, collateralized reinsurance is a good way forward, and as you can see, a growing way forward. The other two are a bit specialist. So ILWs, industry loss warrants. These are mainly instruments used by insurance companies to protect themselves, so they're mainly reinsurance instruments. The payout is based not on the actual loss suffered by the insurer, but by the size of the loss to the entire industry. So you might say, if a particular hurricane has a loss greater than 8 billion, we want to pay out of X. If the total loss to the industry is less than 8 billion, we won't be paid out. So the payout's based not on your loss, but on the industry size loss, which is measured by special companies that perform that task, like PCS in the States. And sidecars are, again, another vehicle by which alternative capital can find its way into insurance. A sidecar is normally used when you're not participating in individual risk, you're participating in a book of business or a portfolio of business. The sidecar can be used. But as you can see from the chart, it's really still cat bonds and collateralized reinsurance that make up the bulk of that 90-odd billion participation that we were just talking about. And here, what I've done here is simply same thing on that slide. So you've got collateralized reinsurance, industry loss warrants, sidecars, and cat bonds, same as we had on the previous slide. But what we're doing here is just showing where in the sort of risk structure these type of solutions are likely to participate. Are they at the sort of 1 in 100 year type event, or are they more aligned with traditional insurance like the 1 in 10 year event? So I'm just making the point that, as I said earlier, collateralized reinsurance tends to sit right alongside traditional insurance and reinsurance, and you can see them side by side there. They tend to be used for the more risky type events. Cat bonds, as the name implies, catastrophe, you tend to find them higher up the risk spectrum. So if you're looking at something that's 1 in 50 years, 1 in 100 years, 1 in 200 years, you might think about going for the cat bonds. Sidecars can go all the way through the structure, depending on where the investors want to participate. Industry loss warrants, quite specialist and quite small, but I still put them on the chart. So that's what it is, and that's where it tends to participate in the sort of risk spectrum, from the high risk stuff to the very remote stuff at the top of that chart. So I've talked a little bit about insurance and reinsurance, but of course ART is becoming of increasing interest to to lots of corporates, and I think when corporates look at these alternative capital mechanisms, they're quite focused on parametric type triggers, a trigger that's not based on the loss that you suffered, but by a physical event, the size of the typhoon, the size of the hurricane, size of an earthquake. And so parametric triggers have become quite popular now in corporate insurance. And the reason for that is the conventional market is very focused on physical damage, right? So the property market, physical damage or losses relating to physical damage. But the problem is there's a huge part of business that is not that focused on physical damage. It's more focused on things like loss of revenue, loss of sales. Look at something like COVID, right? There's no physical damage from COVID, but the business loss, the financial loss is absolutely vast, but it's not a physical damage loss. And so what people look to do with these corporate structures is to say, well, we can cover business interruption, loss of sales, extra expense, loss of revenues. We can cover those types of risks that are not related to physical damage using an alternative capital instrument like a parametric. And the other advantage is when you use parametrics, the claim payouts are very, very quick. It says they're 1 to 2 months, but on some of the ones we've done, it's been less than 7 days. So again, if your motivation is cash flow, you can't really wait 12 to 18 months. You need the money now. And so if you can design a parametric that might work for you, firstly, you can cover risks that are not covered in the traditional market. Secondly, you might get paid out within 10 days rather than 10 months. That's not a criticism, by the way, of the conventional insurance market. The conventional insurance market has to assess the loss to the individual insured before it can pay out. And therefore, that loss assessment process, of course, takes time in order to arrive at the right number. And the more complex the claim, the longer it takes. So it's just the nature of that business. But when you use a parametric trigger, it can respond more quickly. So do these things ever get used? The reason I use this example is I've only been with Allianz, less than 2 years, and this was the first deal that I did for them in this region. And it was the Philippines government looking to buy earthquake and typhoon protection, and they decided to buy that protection on a parametric basis. The total deal size was $386 million. We participated, as did many other insurers, Swiss Re, Munich Re, and some others. Also some pension funds from Scandinavia also participated in this, which is one of the advantages that you have, is that you can open the risk up to other participants if you do it this way. But as I say, the Philippines government a couple of years ago decided to buy earthquake and typhoon protection, not in the conventional market, but on a parametric basis. And you have to say, well, why did they do that? The reason was they wanted to use this money for emergency funding. So disaster recovery funding, that type of thing. So in the event of a typhoon in the Philippines, the government's expected to respond quickly to those events, which is expensive. And they need to have money, and they need to have money quickly. So that's why it lends itself to a parametric where they can get hold of the money in less than 7 days. and then use that money to cover the emergency recovery expenses or the disaster recovery expenses or whatever else that they need. So I think it's a good example of when, when a parametric might fit. And this one was done in conjunction with the World Bank in Washington, who assisted the Philippine government in putting this deal together. So that's just an example for you. Climate solutions. So one of the other areas that ART is very focused in is NatCat and weather. So we've just talked a little bit about NatCat, particularly typhoons and earthquakes. The other big area for ART is weather risk. And actually, weather risk crops up, as you can see from this slide. Weather risk is pretty much everywhere. And we see it in all these guises. So you get it in renewable energy. Obviously, you need wind to turn wind turbines. You need sun, for solar panels. But you also have risks in transportation, airlines. We did a deal looking at an airline that was worried about freezing at airports, which would shut the airport down. You get snow, rain. We're looking at one in Australia right now to do with river levels, a parametric based on the river level to try and protect against unexpected flood events. So you can see that, in the energy industry, in the renewable energy sector, operational, there's lots of different ways of using it, and people even use it for promotional things. So, sometimes you'll see promotions like Bombardier, although they build planes, they still build snowmobiles and things like that. So they did if you bought a snowmobile, you got your money back if there wasn't sufficient snow. Walker's Crisps, a UK company, did a disastrous promotion on where people thought it might rain in England, and that ended up costing quite a lot of money. But you can buy these weather protections for a variety of purposes. That's my point. From an Allianz perspective, our focus, yes, we look at all sorts of weather, but our focus is really in the renewable energy space, and we do these transactions in conjunction with quite an important company called Nephila. And Nephila is the largest insurance-linked security fund in the world. So when we talked earlier about that capital, how does that alternative capital actually make its way into insurance transactions? Well, it often makes its way via these specialist insurance-linked security funds. These are the fund managers who invest on behalf of alternative capital investors in transactions. So a lot of the money that comes in comes through these channels, and Nephila Capital is the largest by some margin of all these ILS funds. So we work with them on these transactions, and in this particular case, we were looking at what's called a proxy revenue swap. Essentially, what this does is protect wind farms and solar farms from the risks of either lack of sun, lack of wind, or a failure to get the pricing that they expect to get. So it hedges the weather risk, which is quite unique, but not that unique. But it also hedges the price risk, the energy price risk, which is unique. And you combine those two together. The advantage of that, it enables a wind farm or a solar farm to know what their revenue is going to be over a 5, 6, 7 year period. Because if their revenue is below what is expected, we pay out under the swap. And if it's larger than anticipated, they pay us under the swap. But the effect of that is that their revenue streams are much more predictable. And that's important for financing these types of projects, because the banks need to know that you can afford to repay their loan. So they like that revenue certainty. So we've done quite a few of these deals now in Australia on the wind and solar side, where we're supporting those projects with these ART wind and price swaps, or solar and price swaps. So these are kind of some of the practical applications for what we do in ART. So that's sort of one vast section of ART. The other section that we should touch upon, though, is what we call structured solutions and integrated solutions. So the other side of ART falls into a broader category that people sometimes call risk financing. if you like, a little bit of a halfway house between self-insurance and completely using the conventional market. You know, is there a different way of doing it? As Trevor mentioned, when the conventional markets turn hard, people start looking at different structures. And the most common structures we find are these structured solutions or integrated solutions. Now, the key features of these deals, for the most part, are in these boxes. So unlike a conventional insurance that tends to be 12 months and then renewed every 12 months, these tend to be multi-year deals, 3 years, 4 years, 5 years. They're also multi-line. So rather than a conventional purchase where you might buy property, you might buy liability, you might buy cyber, you might buy D&O, as separate standalone coverages, we look to bring those lines together into one program. They are bespoke, they're not off the shelf, so they have to be created for each client depending on what is required. But I think the advantage of these deals are the two boxes, bottom left and top right, which is you get pricing certainty over 3, 4, 5 years, and you get stability of capacity over 3, 4, 5 years. So rather than wondering what the price of your insurance is going to be next year and whether there are going to be any insurers around to provide it, with these deals, you get that pricing and stability certainty because it's guaranteed over a longer period of time, which I think makes it attractive. And the other thing is the alignment of interest. You know, there's a sense in which under a conventional policy, if you pay a lot of premium and make no claims, you may feel that you've lost. Conversely, if the insurer pays out full limit losses, they might feel that they've lost. What we're looking to do with these structures is have a program whereby if it goes well, then both sides do well out of the deal. And if it goes badly, both sides share in the losses. So essentially, both sides would share in the losses and both sides would share in the profits. That type of structure. And so that's a slightly different structure from what you'd find, perhaps conventionally. Our capacity for these types of deal is the maximum we could look at was about $300 million. As I said earlier, under these deals, the profit commissions can be significant if the loss performance is good. That's in the top right box. However, in the bottom left corner, additional premiums. So you tend to start with an initial premium, and if the loss record deteriorates beyond a certain point, then additional premiums would become payable. Conversely, if it performs well, then there'd be quite a significant return premium. So that's what I mean by more of a risk-sharing structure than just transferring it to the insurer. You're in partnership with them over the life of the program, essentially. What's not different about these programs is coverage. So when we do these programs, we provide the same AGCS policy wordings that you get from, the other departments at AGCS. So if we work with property, it's a property wording. If we work with aviation, it's an aviation wording. If we work with financial lines and use their cyber wording. So we're not changing the coverage. We're not changing the coverage, not changing the policy. It's just the structure of the deal. The structure of the deal is different. I'm just going to look at this one first. So this is just an example of what a structured deal might look like. So if you look at the diagram, what you've got there is a number of different lines: general liability, products, auto, employees liability. You've got a number of different lines in light green there on my screen. And then above that, you've got the structured program, which is that single block that sits above all of those lines. And if you look at the structure in the bottom left orange box, what you're providing there is a 25 million limit annually across all those lines, $48 million for the term. Now the term in this case, as you'll see below, is 3 years. And you can also see that there is a risk retention across all those lines by the client of 24.75 million. So what you've done there is you've still got the conventional lines sitting beneath you, or conventional deductibles sitting beneath you. You've then got a block of coverage which sits across all those lines, which is not 1 year but 3 years, and therefore you're consolidating that, you know, that purchase and making it in a way more efficient, because you don't want to be buying limits for each of those towers. You're combining it. Now you might say, what if the whole thing blows up? What if you use up your 48 million in 2 years? You can't use it up in less than that because there's an annual limit of 25. But if you blow it up in 2 years, it is possible to have reinstatement provisions to buy back another limit in the worst case scenario. But if you think you're going to blow this coverage up, it may not be the right one for you, because these deals tend to be for clients who have paid considerable premiums over the years. Let's look at the last 5 years, 10 years. What premiums have they paid in versus what losses have they got out? And if you find that, you know, the balance is massively in your favor as a client, you might say to yourself, well, you know, we're prepared to take on one of these structures because we feel confident in our loss record, confident in our risk management. If you're a client that blows up the conventional market every year, you might be better to stick with it up to the point where perhaps the conventional market won't provide coverage anymore, and then one of these deals might come back into play. So I'm slightly exaggerating, but it tends to be for clients, in my experience, for clients with a really good loss record or clients with a really bad loss record tend to come to these structures. But having said that, these structures are much more popular in harder market conditions because many clients are looking for pricing and capacity certainty over a 3 to 5 year period, not a 1 year period, and therefore we've sort of seen a dramatic increase in inquiries about these deals in the last three months or so. So to go, so that's a structured deal, right? That's a block of coverage sitting in a single block across a number of different lines. If it goes well, there's quite a big profit commission. If it goes badly, there would be additional premiums due. So sort of slightly contrast that with this structure, which is the other one we look at, which is, again, in some ways, certainly in the US, more popular. And we call these integrated solutions. Now, if you look at the chart, you'll see it's not a single block anymore. So what you have at the bottom is you've got all those different lines of coverages. And then in the dark blue, you've got ART coverages sitting in different places. On the E&O side, for example, there is conventional coverage above and below. And in property, there's conventional coverage above and below. And on crime and fiduciary and EPL, it's sitting just above those deductibles. So what you're doing here, contrasting it with the other slide, in integrated, you're buying sort of pockets of ART in different places within your conventional program. But if you look on the bottom left in the orange box, although those boxes are all over the place, they're joined together because across all those boxes combined, there is a single limit of 25 million. Any one single loss is limited to 25 million, regardless of which box it occurs in. And then there's a limit of 100 million per annum. And in this case, there is also a limit of 100 million for the term. So you're buying those coverage in different places, but they are being bound together by a limit which they share, both per occurrence limit and an annual limit and a limit for the entire term, which in this case is 3 years. The difference about these structures is that these integrated structures tend to have fixed premiums, and that's an important benefit, I think. So when you look at the structured solutions, you're saying to, what we're saying to clients is, if you go for a structured solution, you have a much greater financial participation in your loss performance. That means that if it goes badly, you're going to pay significant additional premiums. But if it goes well, we'll give you profit commissions, perhaps up to 70–80%. So there's a huge upside and a huge downside. Some clients like that, and some don't like the uncertainty that creates. And for clients that don't like the uncertainty, they tend to look more at these integrated type solutions where you're still buying pockets of ART. It's still multi-year. You're still having a single limit for the program, an annual limit for the program. But in these cases, the premium is fixed. So there can't be, there can't be any surprises there with regard to the premium. When I say fixed, you will see in the box above benefits, I can't see what color that is, it looks pink on my screen, but it says annual exposure adjustment clause. So when I say the premiums are fixed, it has to be in relation to the exposure, because if it's a property portfolio and you're doubling the size of the underlying property portfolio, then there has to be a change in the premium. So when I say fixed, I don't mean the quantum, I mean the rate's fixed. Quantum has to adjust based on the underlying exposure. It could go up or down. So I think that's an important distinction to make, that there is, because these are long programs, 3 years, 4 years, 5 years, there has to be some relationship to the underlying exposure that you're insuring. So those are two examples of ART risk financing. This one tends to be called multi-year, multi-line. This one is integrated. These can be used by corporates or by captives, or indeed by insurance companies themselves. And a number of companies who are thinking about setting up a captive, they might think, well, we want to have a captive, but we're not sure we're quite ready. Is there a stepping stone between conventional and captive? Can we sort of try this out without setting up a captive? A number of those companies go for a structured solution, because these are sometimes called virtual captives, because you're sort of halfway getting towards a captive. You're taking much more participation in the risk, but the insurer's still there in the event of a crisis. So these are sometimes called virtual captives, and often used as stepping stones between conventional and captive. They would sit in between until you were ready to go to a full captive. So just finally, because I think I want to leave time for questions, finally then, the benefits of these risk financing structures are that you get pricing capacity over the longer term. I think you get a better alignment of interest with the insurer. It's a good way to manage your risk retention over the longer term and manage your volatility, because it's important where you decide to put the boxes of ART cover in order to in order to help manage the volatility of exposures that you might have. So many corporates would say, look, if losses were predictable, we'd be fine. There's a certain amount of loss that we can take every year. It's only the really volatile stuff that worries us. And therefore you can structure these programs to cater for that volatility. As I just mentioned, often called a virtual captive, because a little bit of a halfway house between self-insurance and conventional insurance. And as I showed you on the integrated slide, this is not an all or nothing. You can have ART embedded in conventional. You can have ART and conventional sitting side by side. You could have a property program where 50% of it was property conventional, 50% of it was ART sitting side by side on the same layer. I mean, you can put it in different layers, but you can also have ART sitting side by side with conventional. Policy wording is the same from AGCS. We use their wordings. We don't have any in ART. We use their claims expertise. We don't have our own claims. So when we do something with property, for instance, it's their policy, their claims, it's their risk engineering reports. All we're doing is adding a different structure to the deal. We're not changing everything. And just lastly, on the alternative capital side, we've been doing quite a bit of work in this region, covering earthquakes in New Zealand, covering earthquakes in Japan. We are quite big users of the alternative capital market. We're going to try and increase that to cover other countries and other perils. I see that as a growing market. And interestingly, during this COVID time, the alternative capital market, the cat bond market, has held up very well. And the reason is that there's very little very little correlation between earthquakes, typhoons, and COVID, right? There's also very little correlation between the stock markets, currency markets, and interest rate markets, and natural catastrophes. So one of the reasons that one of the reasons investors invest in alternative capital is because they see it as not correlated to all the other assets that they might own. So if you own Australia property, US property, London property, Australia stocks, UK stocks, New York stocks, all those things to some degree tend to move together in the event of a crisis, as we're seeing now. But there's very little correlation between any of that and the incidents with which typhoons take place in the Philippines. So when people are investors are looking to buy these instruments, it's the fact that they're not correlated to almost any other instrument that makes them particularly appealing. And I think that's why the market's growing, and that's why it's growing particularly rapidly now, as institutional investors are saying, I don't want to be in the stock markets, I don't want to be in the property market, I don't want to be in currency, I don't want to be in interest rates. I'm going to put some more money into insurance-linked securities. And that's why right at the beginning, I think you could see that chart growing. So that's a little bit of a sort of walk through ART from me, covering, if you will, the alternative capital market side, with the parametrics, with the insurance-linked security funds, and then separately looking at some of these risk financing structures, which look at providing coverage on a multi-year, multi-line basis. And when you bring that together with the weather risks and the climate risks, that for Allianz really does cover much of the ART work that we do. So I'll stop there, Trevor, and allow you to. I'm not sure everything's working on my screen, so if you want to raise any questions with me, let me know what they are.
Thank you, Richard. I certainly will. And we do have a couple of questions, but before I just read those out, I do please encourage our whole audience to throw out some questions there, and we'll get through as many as we can. So I will start with the first two, which are both from Simon. So the first question is collateralized RE a new version of an old Lloyd's name?
Oh, that's yeah, that's actually quite a good question. I think the simple answer to that is yes. Lloyd's names had to post collateral. It obviously cost many of them quite a lot of money in the end, certainly during a period of time that I can recall in the 80s. So yes, I mean, I think to answer that question more seriously, yes. I think it is quite similar in that rather than having a private name or an individual having to post collateral and having to pledge assets, which is what the names at Lloyd's used to do, you are saying quite similar things to a financial institution and saying that you need to pledge, you need to pledge collateral and be ready to support these transactions if the collateral is insufficient. I guess the $6 million question is how much collateral is enough? And if you think about it, it doesn't really make sense for these entities to collateralize every insurance policy to its full policy limit, because that's perhaps an unrealistic scenario. But the minute you move away from that, you're saying, well, how much collateral do we need? In practice, the amount of collateral that is called upon tends to be based on models, like a modeled output. So you'll say, okay, we'll call enough collateral to cover us for everything up to including 1 in 500-year event. So the collateral is a modeled number. But yeah, I would say yes, not dissimilar, except it's financial institutions putting up the capital rather than private individuals.
So then that probably just leads me to two sub-questions before we move on to the next question. Is the collateral secured, and is it unlimited liability, like the old Lloyd's names?
Yes. So the way the collateral arrangement works is that they place collateral in the agreed form in a collateral trust account. In our case, we've got collateral trust accounts with the Bank of New York, for example. So NEFLA put collateral into those trust accounts, and we have to decide what form that collateral should take. Obviously, the more liquid, the better. With respect to the second question, I can't generalize about what a rate. I mean, there are 50, 60, ILS funds in the world. There are many collateralized reinsurance arrangements currently in place. So I can't generalize on what arrangements they all have because I haven't seen them. These are private placements. But generally, the funds would be liable behind their obligations to the full extent that they can meet those obligations, but not totally unlimited, as in the case of Lloyd's, where people start taking your house off you. No.
Okay, thank you. The next question, again from Simon. In the revenue swap example, there would have to be a rigor around the measurement of the insured's revenue. So they can't hide revenue to avoid swap back. Is that true? Yes,
that is true. So I think the Australian, that instrument, by the way, the reason it works in Australia is Australia has a slightly different energy market to other parts of this region. So in many parts of Asia, for instance, renewable energy operators don't have price risk because the government guarantees them a feed-in tariff of a certain amount, so they don't have the price exposure. In Australia, that's not the case, and therefore they are exposed to price risk as well as weather risk. And I think that's why that instrument works there. But yeah, the swap documentation and the swap transaction requires that the project sponsor or the swap counterparty is completely transparent about their revenues. But actually, beyond that, both NEFLA and ourselves, we have models and we have live data which shows us what's going on with the sun or the wind, right? We also have outputs from those solar and wind farms which show us what's actually happening on the ground. Now, if you know what the sun's doing, or you know what the wind speeds are, and you know what the wind is doing at that particular facility, and you also have access to the price risk information, you can work out what their revenues might be. But to answer the question, yes, they have to be completely transparent about revenues, and their revenues can be checked at any time if we want to check them, and they are checked relatively. They are checked relatively frequently. So yeah, it does require honesty and transparency. What I would say there is we're not covering the operational risk, right? So we're covering the wind or solar and the price risk. What if the wind turbines break down? And what if that's the reason that they're not producing enough power? What if the wind turbines don't work? Or what if the solar panels fail? What if half the solar panels are out? We're not looking at covering those operational exposures. We're not guaranteeing the performance of wind turbines. We're just looking at the weather exposure and looking at the price risk.
Thank you. The next question is from Eamon, who's our chapter president. He likes to thank you for your presentation, which he felt was great. And his question is, how do you debunk the notion held by some corporate insureds that the art marketplace invariably views most prospects as stressed buyers who cannot get a solution from their more conventional insurance programs?
Well, I don't have any issue with stressed buyers. The thing is that the reality is that corporates will only turn to ART when they perceive that it provides something that they really need at the time they need it. So we talked a bit earlier about those longer term deals, 3, 4, 5 years. Now, the fact is, if the conventional insurance market is dropping in premium year on year on year, a lot of corporates understandably be reluctant to lock into a longer term deal. The minute the market hardens, those kind of deals become more interesting. So I wouldn't necessarily say that was sort of stress buyers. It's more, in a way, I guess, opportunistic buyers, or buying in line with the market conditions. So I think that makes sense. Yes, we do sometimes get buyers that can't find conventional solutions, but that's okay too. That's what we're here for. So I think there can be a variety of circumstances. And the other thing is, what if you've got a client who's looking for coverage which is not, conventionally available? So they're not interested in physical damage, they're interested in loss of revenue. So you sometimes have clients who can't get the precise coverage that they want in the conventional market, and therefore saying, well, the solution we need only exists in the alternative market. So yeah, I think it depends what the buyers are looking for. Some clients find the idea of parametric triggers quite appealing. They'll come over to ART. In a hardening market, those longer term deals are quite appealing. They'll have a look at ART. Some buyers may not be able to get what they want at all in the conventional market, and they'll have a look at ART. So yeah, I mean, I think we're here for all of those potential groups of buyers, and it doesn't concern me that people come to us only when they're stressed.
Okay, thank you. The next question is from Lokesh. Is parametric insurance part of the ART solution because of the current reduced capacity deployment and change in risk appetite from major insurers?
What, parametric?
Yeah. I suppose is the increase in parametric insurance part of the fact that the conventional market's collapsing a little bit?
Yeah, I think the increase in parametric, from my experience, is being driven by the fact that clients are looking for, as I said, a different type of coverage. So there's not, everyone has to have their property insured. I get that, and property insurance is important. But when the risk that concerns you is nothing to do with physical damage, it's more to do with the loss of sales and loss of revenue, then where are you going to turn? That non-damage business interruption space is a space, in my view, which lends itself to parametrics. Not just because we can cover those types of events, but the speed of the payment's important too. So we looked at a casino in Macau that said, look, the casino's insured, but that's not what's concerning us. That's fine. We're not going to not insure the casinos. But in the event of a typhoon off Hong Kong, what happens is no one comes to Macau, and therefore our revenue goes down. So can we have a parametric covering typhoon where the payout helps us with our loss of customer revenue? Nothing to do with physical damage. Doesn't matter whether the buildings are affected or at all. So you can see in that example that sometimes what's driving parametrics is clients looking to cover a financial risk exposure rather than a physical damage exposure. And I think that's driving a lot of the appetite for parametrics at the moment. So it's not a lack of sort of total capacity in the conventional market. It's the conventional market not providing that some of these clients are looking for. Bear in mind, the parametric market's still pretty small compared with where the conventional is, but it does work for certain types of scenario and certain types of client.
My next question is from Mr. Bates, who is also a member of the RIMS board. He'd like to say it's an excellent presentation. Do you see a time when ART options will provide large enough capacity to really challenge traditional programs rather than augment them?
Yeah, I mean, I think we saw on the first slide, didn't we, that alternative capital is now roughly, on that slide, 16% of the overall market. And when I say reinsurance capital, I mean that capital is deployed into the insurance market. That's where it goes. And so it's not unrelated to this topic. I think that number will continue to grow. I think we'll probably hit 25%, not 16, in the coming years. So I would say this. I would say that for on the reinsurance side, alternative capital is already a very significant force. In terms of alternative capital solutions and techniques being a force on the conventional side, I think it's something that we will we will see a lot of at times like this when there are hardening markets, and then perhaps it will drift away a bit more when the conventional markets go soft again, which I guess they eventually will. But my point is that there'll be many people in the audience perhaps who are using alternative capital without even realizing it. And when I say that, I mean they'll be buying a conventional insurance policy. Behind that policy will be a reinsurance. Behind that reinsurance will be alternative capital. So they might not think they're using the alternative capital market, and they may not be directly, but behind them, you might be surprised to learn that alternative capital is being deployed, and it's that alternative capital that's enabling those insurers to offer those policies at the front end. So yeah, very significant on the reinsurance side, and that feeds through, of course, into what's available on the conventional side.
Excellent. Again, I'll just invite everyone to, if they've got any further questions, but I do actually have one, is if we do see more interest in this area from corporates, do you see any alternative disruptors entering the market, or do you see innovation entering this space?
Yeah, I mean, I think once you start looking at transactions in this way, then it does open itself up to, I think it does open itself up to, to being perhaps a bit more innovative on the insurance side. And if you've got, there are already systems out there now, and if you've got a parametric trigger, then a computer can sell you an insurance policy. You don't need an underwriter, right? So you've already got a situation now in the US where people can buy Florida parametric wind protection from a computer. And that computer is selling Florida wind protection 24 hours a day, not to large corporates, actually, to SMEs. So it's not just a big corporate game. That one's for SMEs. So I think we will see I think we will see more innovation in tech coming into this space. And I think particularly what we'll probably see is more automation in the underwriting process, and clients able to perhaps purchase really quite sophisticated insurances online, which wouldn't have been possible before. And I think the other thing which I mentioned is that I was reading a study recently that said that in the 1970s, most corporate value was intangible assets, whereas now it was saying that 90% of all corporate value is in intangible assets, like people, processes, systems, data, trademarks, trade secrets, patents, and therefore one of the innovations we're looking out for from the insurance industry is a greater focus perhaps on intangible assets, not just intangible asset protections rather than just tangible asset protections. And I think that that some of the ART instruments like parametrics can help in that space.
Wonderful. Well, I think we'll keep the idea of a world without underwriters on the download for the time being, but thank you very much. And
thank you for your time.
No, and I'd just like to thank you for all your insights and your time and a wonderful explanation of a quite tricky area. And I'd like to also extend our thanks to the session sponsor, which is Allianz.
Thank you for your time.
Thank you. So I'd just, for anyone who's still online, I'd just like to remind everyone that our next session starts at 8 AM tomorrow morning. So please join Adam Saplina and Kevin Bates for Challenging Times, the D&O Market. Sounds very Dickensian. Attendees are welcome to attend sessions that they may not have previously registered for, and the access link is the same as the one that you used for today. If anyone is interested in becoming a member of the Australasian chapter, please visit the RIMS global website, www.rims.org, for further details. And finally, we would love you to complete the post-attendee survey and let us know what your thoughts on this session and other sessions that we have. So I'll just leave it there, and thank you again, Richard.
Thank you.